Mr. Malik, the CEO and MD at Adani Wilmar is joining in with us, as well as Mr. Kanare, the CFO at Adani Wilmar is joining in with us. Very good afternoon, gentlemen. And I just want to start, Mr. Malik, with terms of the commodity prices. When you look at the commodity prices, palm oil prices, month-on-month basis, year-on-year basis, now we're seeing a decline coming in. The company had taken price cuts before as well. Now, what we're understanding is reports are suggesting that we'll be seeing more of a price cut coming in. Could you give us an understanding in terms of, what is the on-ground situation currently? Is the company looking at taking any price cuts? And then what are the margins looking then at?
You are right that the commodity prices have come off from the top, and as any other branded edible oil player, we have been watching the commodity prices, and accordingly our MRP has also been reduced. To begin with, say in January, soybean, our Fortune soybean oil 1 litre pouch was 170 rupees MRP in Delhi, which is today 140. So you can know that over the period from January to May, we have reduced it gradually, basis how the overall commodity prices are.
Right. Good afternoon, Mr. Malik, as well as Kanare. There is Cheryl also joining in the conversation. Let's talk about the inventory cost. We know that the high inventory cost also impacted your margins in the quarter gone by. If you could tell us how much of that still continues to persist, and also will it impact your Q1 FY24 as well?
Yeah, I'll take that question. In fact, as far as the inventory cost is concerned, I think one of the major element in inventory cost is, of course, the interest cost. And I think we all know the rate hiking which has been going on for last more than a year. Actually, that impacted our overall performance in terms of bottom line. That still continues. Today also, we are sitting on an interest rate which are quite high. There is no possibility or nothing like interest rate cuts which we are expecting. So those will continue. But however, as we move forward, I think since the edible oil prices have come off and have been stabilized, the demand is coming up, I think we should be able to, pass on this interest rate and other inventory costs to the consumer.
Okay, you'll be able to pass on that to the consumer. But also, I just want to understand in terms of just rural market, that is an important factor that comes in for most of the companies as well. How is that shaping up for the company? What are we seeing in terms of the rural market trends? Because obviously we are seeing unseasonal rains coming in, could see an impact on the crop. So all that could in turn somehow impact us as well, because we do have the FMCG business as well. So what is that indication we're getting there right now?
On this, I had said that the first 2 quarters of this year of FY23, the rural markets was definitely not supportive. Things started opening up from Q3 when we saw after the harvest, the rural economy started going up. But in January, I had said that the rural market now looks much better than Q3. So Q4 was looking better. Just to give you an idea about how the edible oil and branded staples food business has done urban versus rural. If I go Q1, the rural share in edible oil was 30%. For us, when we take rural at Adani Wilmar, we consider any town less than 1 lakh population is all rural, and anything above that is urban. So 30% would come from rural. Then Q2 was 29%. After that, Q3 was 29%, but in Q4 we got 31% share. So that means in Q4, there was surely an up movement about the rural. The same if you see in foods, very interesting. 29% share came from rural, then 30% Q2, 30% Q3, and 34% Q4. That means in Q4, both staples food, that is packed rice, wheat flour, sugar, pulses, dal, oil, all these products have shown surely a better result in Q4. So that should indicate that rural possibly is opening up. One of the reasons I see is that edible oil prices have come down, the consumption has gone up. So rural has started consuming at least the edible oil, branded staples better.
Hopefully things will look brighter going ahead, Mr. Malik. But then let's talk about your food and your FMCG business. Segmentally, if you look at the performance in the quarter gone by, there's been a sharp improvement. Also, over the course of 1 year, we've been seeing improvement in that particular segment. So going ahead, where do you see this one headed from here on? How much of a contribution do you see for this particular segment to have on your overall revenue?
See, we have been focusing on food since last 2, 3 years surely, and we have been ramping up our processing capacities. We are bringing in new assets. So today, if you see the food volume is roughly around 17%, Shrikant, 17% of the total. This was lower last year at around 13%. Going forward, if we continue to grow at around 40-45%, that's what we have been doing, because we have doubled the turnover of food in 2 years. If we can continue this type of pressure, which we see there is a possibility, because honestly, the branded food segment is much smaller than oil. Oil is at 70-75% branded, but if you take atta, which is the largest staple food, is 12% branded, rice is 5-8%, pulses is 5%, sugar is 5-7%. So there is great room to grow in the branded commodities, and we are surely concentrating on that because we see there is great opportunity.
Okay, thank you so much, gentlemen, for joining in with us this afternoon on our Market Fatafat, giving us an understanding on the numbers, and obviously FMCG is going to be a focus for them as well.